Ladies and gentlemen of the crypto space, we're live on a Monday, September 9th at 11:38 a.m. This is the wrong screen. Let me fix that. And you can see my big face in the meantime. Stop screen, present, share screen. Yeah. All right, that's better. Okay. Hi, everyone. Let's pop over to the comments channel if you're on X or on YouTube. What's on your mind? What are you thinking? That's the best way to get some feedback. The only way to grow is with questions and answers. I tell that to my kids all the time. Never stop asking questions. You know who the best person to ask questions to? Yourself. Um, Market update first and foremost. This is a crossroads. This is the inflection point, the transition, and clearly that's expressed from a Federal Reserve standpoint with regard to them talking about rate cuts. And we're September 9th. We're talking about 9 days. Middle end of next week, middle of next week, whatever, the 18th. And that's an expression of the inflection point. They are responding to market conditions that we are looking at. This is the data that we have. This is the highest level of data. Clearly, they have much more fundamental data, which really manifests the data that we're looking at the highest of levels. So this is clearly an inflection point from a currency standpoint. It's also an inflection point from a collateral volatility standpoint. Now, the uncertainty diminishes every inspection of every day for a person that has an understanding of the potential volatility along the path in context of pretty much the solidified and inevitable destination. The reality that we've talked about over the last years at this point, which feels like forever, is the absolute need and the certainty that government debt will be refinanced is impossible. This it's not even a point of stating paid back. The deficit spending every year. So that creates a condition where debt that matures literally needs to be financed. If you're deficit spending, it's akin to literally not having the money to cover the current bills, yet alone the bills that are coming due. So the process of refinancing requires liquidity, which requires a collateral market that can withstand increasing supply. And that is the process of smooth market function from a treasury perspective. And that's their entire job. Their entire job, along with assistance, either indirect or direct at times from the Federal Reserve, is the management of smooth market function. What is smooth market function? Smooth market function is the suppression of volatility. You want an orderly bid ask process. You don't want price to go all over the place because when there's a lot of price action, you can't make decisions. You certainly can't make collateralization and credit decisions when rates associated with significantly fluctuating collateral prices are moving rapidly. Can't especially make long term decisions about structured financing. And that makes it extremely difficult for banks at all levels to engage in any type of credit operations. So that is from a currency supply standpoint. We've seen some headlines recently about equity markets globally significantly declining. And that is a form of collateral. It's a component of the global collateral composition. And collateral, whether you're talking about debt or equities, is just collateral. Now, this is literally a framework, meaning people invest in price action of the equities market, but I don't give a shit. What's pertinent is the um, fair market value, which is clearly an inflated number, is used as ultimately collateral for currency creation. And there's more volatility in equity markets, so there's less use of it for currency creation as compared to what historically was sovereign debt markets, which were supposed to be increasingly stable with regard to volatility. Therefore, you can use it much more comfortably for currency creation. Of late, especially post 2020, there's been significant volatility in sovereign debt markets, which has created this current cycle. It's exactly why we have a prolonged bear period between what we see clearly in the Bitcoin chart. I don't have the I don't have the time frames up, but if you look at the time period from peak to intersection of, let's say, the 200 SMA on the weekly, um, I'll put the time frames up. It's actually an interesting inspection. 217, and we had 364 days. You want to go back probably one, not really one. This should be fine. So there's like a top, and here's our first interaction. I mean, we could take even just the second, the support flip resistance indication, and that took 280 days. Maybe it's not. Maybe it's the daily. That's the better inspection. What was I looking at earlier? Maybe it was the weekly. Was it the monthly? Just double checking. 2 seconds. Reset price scale. No, it was the weekly. Because we have the bullish cross of the 100 SMA with the 200 SMA. And from, well, that's probably not the best inspection. I think it was, okay, that's why it was the 50 SMA, 448 days. And then here, oh, that's what I was doing. I'm just trying to illustrate an interesting inspection. If we put the chart on and we hide the price point, hide, and then we're taking it from the peak to the trough in the 50 SMA, intersecting the 200. Now we adjust here, peak. All right, maybe this isn't the best example, but the point was this is the longest cycle of underperformance for Bitcoin in the last 10 years. Um, I just forget which chart I was drawing on that depicted that. Maybe I could find it in my history. I certainly can find it in my history. See this, I had it up on the last show, part of it. I kind of want to find it. Longest cycle, we'll find it real quick. It's only a couple of pips. Here we go. As simple as that. What was I looking at? I was looking at the weekly, and I was looking at price action, peak to trough intersection with the 200 SMA. So back in 16, it took 349 days. Back in 2020, it was literally 105 days for that final retrace. And this is where we are right now. Basically, it took 707 days, twice as long as the 2016 cycle, to finally hit a mean regression. This is the dollar. Okay, I'm all over with this narrative. This is a better expression of the trajectory of Bitcoin, or rather the conditions surrounding Bitcoin price action. How long it's taken for the dollar to finally retrace to a moving average. And once it falls below, you finally get the outperformance in liquidity sensitive assets, specifically Bitcoin and cryptocurrencies more broadly. So let's go to this chart and we could talk about that real quick. We'll put the price point back on. Peak. This is on the weekly. Can I draw this real quick? Or am I? So fall through, peak, fall through. Why? And I'll explain why I'm drawing this chart if I can. If I can literally do anything right on the spot. And we're literally right here. We finally get to the mean regression. All right, this is the thought that I was thinking. 342 days in 16, 112 days in 2020, and then 707 in 2022. So your crypto bull markets are obviously most strongest when the dollar depreciates significantly below the 200 SMA in the weekly. That's just historically what the 2016-17 cycle was and the 2020 and 21 cycle was. So it hasn't even started yet. I've stated that for literally the last 2 years, all the way through the beginning of 2024, when memes were hot and Solana repriced from $8 to $170, and Bitcoin bounced from 15K to basically punching all-time high very briefly. But that price action was a manifestation of currency that already existed in a situation that was either before or during contraction of global currency supply. We haven't entered the expansion phase of global currency supply. I guess a great point to highlight right now is that that's a negative sum environment. It's very comparable to when we look at DeFi Llama and we're looking at whether there's increased or decreased amount of stablecoins on a particular network. And I mentioned earlier that equity markets declined trillions of dollars globally in the recent past. And that is an expression of global currency supply deflation. They are finally starting, and it's taken 2 years since 2022 to get a grip on the mechanics that allow the system to actually maintain at minimum, but also grow currency supply to facilitate productivity, incentive systems, and ultimately GDP. Now, the biggest burden thus far has been China's real estate collapse, which is literally 90%. 90% of the real estate market in China has completely collapsed. This cycle has been a 2008 in China. And all of that has bled over to the entire world. So when a market in another foreign country, relatively speaking, of course, is deflating, they compensate by inflating. But that and by doing so, they're exporting inflation because they're subsidizing all the manufacturing and they're trying to boost productivity with stimulus, so on and so forth, that they're getting cheap products, cheap products, cheap products, and all that shit lands as exports. So that's basically an export of they're exporting their inflation. That's so when you're deflating as a country, you're attempting to export inflation, and that boosts. Um, it's all relative, cause and effect, and it's an inverse correlation. Um, so right now, I think maybe China's finally getting a grip on it, and that's probably best expressed in the capacity for collateral volatility to finally start rolling over. And once we see volatility roll over, we get the currency expansion cycle. I don't know. That was kind of a coherent story, more or less accurate, trying to express a market update of where we are in this entire thing we call a cycle, which hasn't even started yet. That has been the statement for quite some time, and I stand by it. And we won't see any interesting price action where we get to see what the destination is. We know the destination is an expansion, is a further appreciation of these fintech products and services. We don't know how much appreciation. We know it will appreciate because the technology is insane. And during this deflationary period in crypto markets, things have held up extraordinarily well compared to past experiences, compared to past cycles. It's quite different in that regard. I know that from personal experience, and a lot of people could probably infer that from social media commentary. But that is very much a quantitative observation by the fact that we actually have a DeFi llama at this point. Got to understand, none of this shit existed in the last cycle, so all of this is quite quantifiable at this point. It's not even on-chain data, I guess. Better said, that's not a rigorous inspection of on-chain data, but DeFi llama certainly is, and uh, an expression of metrics from on-chain activity, and it remains extraordinary Being flabbergasted to be able to best describe it. How extraordinary. So move rolling over, at least it's an expression of resistance on the 100 on the weekly. And this, by definition, is an expression of volatility suppression resulting from a collusion of all central banks globally in order to get the collateral markets under control. Now, this is US debt. Um, and from a global perspective, this remains the most interesting debt relative to the debt of other countries. Other countries are in shambles. I mean, you're talking about an absolute mess out there. And clearly, we know it's a mess here in the States, but relatively, it's the same thing that like Brett Johnson has talked about. Michael Howe being a shirt in a dirty ass pile of laundry. But that's real. So when people want currency and people want debt as collateral, they go to these types of instruments. And that'll change over the next 10, 15, 20 years. But this next cycle is going to cycle in very much the way it has historically cycled. You'll see your bond depreciation. You'll see the yield curve on invert, which is obviously what folks have been talking about. Yield curve on inversion means US debt's being bought, and it's being bought in a very obvious way. Still uninverted 3.7 on the 10-year compared to the 2-year at 3.66. Let's see where the 30 year is at. 30-year sitting at 4%. So for the 30-year versus the 10 years uninverted, it's literally the uninversion, where the long end pays more than the short end. But still, the short end, so it's not a, they're not a, they're at a policy error. Why? Because their damn rate adjustment system is low as shit. If the long end is being if the rates on the long end remain lower than the short end and they're in control of the short end, you want a yield curve that's not inverted, and that facilitates smooth market function of the entire debt construct, where you could borrow short and lend long. So that, by definition, is a policy error. An inverted yield curve is a policy error. I think that's the case. Now, so them responding to consumer price inflation using increased short-term interest rates was a mistake. Clearly, in an environment, this is stuff that Linda Alden talks about, in an environment with regard to fiscal dominance, an environment where the bank credit is facilitating excess supply of currency, which means excess demand, want to increase rates to slow down banks creating currency, which slows down demand. But this wasn't bank fueled credit that facilitated supply demand imbalance from a consumer price standpoint. This was literally federal government deficit spending. So if an increasing interest rate is designed to slow down credit, it sure as hell didn't slow down our government's credit. They just kept borrowing at the increasing rate, the increasing rate. So it literally, their policy didn't do anything with regard to what has become the primary creditor in this market environment, which is the federal government. Deficit spending is what it is. Didn't slow it down at all. So that's clearly the primary expression of a lot of macroeconomists nowadays that the fiscal deficit spending is what fueled the experienced consumer price inflation, part of a fiscally dominant uh, financial condition. Policy error, something I've been talking about in my documentation recently, because we see that's a policy error and they can't cure it the right way. The right way is to boost availability of goods and services. to reduce prices, but they have literally no control over that. They only have interest rate policy control. So they probably all talk about this shit. But what the hell are you going to do with interest rates? What they've done over the last decades, pushing the entire manufacturing sector offshore because of relative currency pricing, which you see in the DXY. Got to zoom out for that one. Go out to the yearly. Since 2008, it's further exacerbated with the lower highs. But since the 70s, as uh, as the dollar cyclically becomes expensive, it encourages the offshoring of currency as foreign currencies get cheaper and cheaper in the face of a relatively and cyclically strong dollar. The exportation, the globalization of the American supply chain. So if you had a domestic US supply chain, government policy can clearly be geared and adjusted to incentivize increased productivity, tax breaks, or grants, or just subsidization to increase supply. So if deficit spending is used to say, hey, manufacturing plant, hire double workforce, build a facility, and run it overtime and crank your supply up. I know you're going to get a decreased profit, but we're going to subsidize the shit out of you. Okay, so if the $1.8 trillion dollars in deficit spending we did this year is used in that way, boosting supply of goods and services, great. There's your deficit spending that reduces consumer price inflationary pressures. That's clearly not what we spent the money on. So they didn't pull the right levers. So, in my fiduciary opinion, everything post stimulus complicated in 2020, the stimmy checks. That opens up a can of worms of conversation. But point being, at minimum, my fiduciary opinion is that the Federal Reserve policy for adjusting interest rates to cure consumer price inflation was a policy error, considering the fact that there's no alternative, and that is a risk. And that has created a massive liability for capital managers to have to wrap their heads around and attempt to mitigate as best possible. Anyway, it's a couple of interesting sections in my documentation where I discuss Federal Reserve policy error. And that's a clear interpretation with plenty of argument that I've introduced that substantiates why that's obviously the case. Anywho, that is something that a lot of folks on social media, macroeconomists, say they're going to have to reverse course quickly. We'll have emergency rate cuts, not necessarily intra FOMC meeting, but they'll probably be outsized. Even Federal Reserve FOMC board members have said front load the rate cuts. Literally what they said about the rate hikes. Front load the rate hikes. Yeah, that basically translates to they're going to cut the shit out of rates in order to catch back up with the fact that the 2 year against Fed Fed funds rate has diverged. Now, historically, they didn't do too bad in 2000, the Fed funds rate, and they lowered it relatively quickly. But look at that. Look at that. Fed funds is at 5.3, but the 2 years down at 3.6. They should have cut last meeting, period. So I could literally take a screenshot of this chart, highlight that section of the chart, and state that in my fiduciary opinion, that's a policy error based on past precedents, at least by the 2 year chart going back to 1989. It's stated in the chart. They historically they adjusted better, and now they are late to cut. So that's a risk with the liabilities that they create, which are dollars. That's the construct. Um, Back to Bitcoin price for a second. We'll go into the weekly. Generally speaking, this is the probably the most interesting inspection right now. of the Bitcoin price. If you go over here and we get it selected right here. So notice these two circles. We are here. This is where we were back in 2021. First price action intersection with the 50 SMA. We are now here with a price action intersection with the 50 SMA. But completely different conditions. Federal Reserve, Fed funds rate cutting cycle, move indicator rolling over, dollar cross currency pairs starting to change directionality, and even merely from a technical standpoint on this Bitcoin chart with the 100 SMA rolling below the 200 SMA, literally for the first time in forever. It never occurred. And now it's a bullish cross of the 100 SMA and the 200 SMA. So this is absolutely fascinating conditions from a currency standpoint, from a bond market volatility standpoint, from a Federal Reserve policy error, and them having the front load catch up standpoint, also from a Bitcoin price action standpoint, and finally from a Bitcoin moving average standpoint. This isn't even a trifecta of bullish confluence. This is a fivefecta of bullish confluence. Literally have five key pieces of, of data that indicate these conditions are fascinating. Period. Tell me right now these conditions, considering the other macroeconomic conditions, are far superior than what we felt in December of 21 because people likely remember it. I clearly remember it. I mean, it was rolling over and it didn't stop rolling over until November 22, down to 15,000. I mean, that was a hell of a year of FTX, Celsius, BlockFi. Come on, that shit was crazy, and it just kept going. So these conditions right now are day and night compared to December 21. Anywho, anything else interesting? Uh, M1. I mean, literally M1. This they'll have to catch up at some point. I would love to do one final thing, and then we could go to commentary. We're gonna do a little chat GPT experiment. Um, Search as required to identify the total amount of U.S. debt that matures in 2024. So we start with our first question. All right, so we cancel that. We got the information. Don't forget to include any um, isolated debt specific to 2020 pandemic response. Okay, here we go. It's a fun exercise because it does all the work for you if it doesn't get stuck. Oh, it did get stuck. Okay, there you go. Uh, uh, the what is the cumulative amount of debt part of normal refinancing due to maturity added to total specific debt? And now it does the work. It's not 7 point, it's more. Uh, I remember seeing 10.8 at one point. I don't think it's finding all the debt because it's always saying 7.6 and a portion of. Okay, one more question. What is the total amount of US debt that needs to be refinanced in 2024? Not 7.6 trillion. It's more like 10.8 trillion. Of that amount, how much has been refinanced thus far? It's literally a conversation. I'd have to probably do some due diligence on my own. Okay. You have to go into treasury auctions to see. Over the, yeah. All right, fine. Wasted conversation. I would need to give it more specific information and some better sources. But the point being, based on my most recent analysis, $10.8 trillion needs to be refinanced in 2024, and interest rates have yet to come down. So, logically speaking, Treasury's like, why am I going to issue debt in peak interest rate environment as compared to a reduced interest rate environment that is literally coming and starting in September. So, from a refinancing standpoint, they're going to not front load to the beginning of the year, but post load to the end of the year the majority of debt refinancing in order to take advantage of a decreasing interest rate environment and be able to issue the trillions of dollars of debt at a discounted interest rate. They have to pay less on what they're borrowing. Now, I find this fascinating because that is means in order to issue that debt, they need to get volatility under control. And we go back to this chart for that, the move indicator. There's no way if they start issuing what they need to issue to account for total debt refinancing obligations, um, they can't afford a blowout. Period. You think that in these market conditions, that's not gonna freak the shit out of equity markets? Any blowout in a debt market volatility freaks everyone out, and everyone sells whatever they can because they don't know the price of money. They don't know if they're gonna be able to borrow or how much they're gonna have to pay back, or if their existing debt is effectively collateralized and they potentially risk liquidation. So everything gets sold. This is not the time they want to do that because the equity markets are already rolling over. So, point being, the market sees this, and that's why we got a pretty decent mean regression in the Nasdaq down to 17 and change. S&P didn't even have to touch 50 SMA on the weekly, and it's likely the case that insiders know Treasury policies, insiders know DTCC is probably spinning up and they have circuit breakers in there, and they'll be able to crush bond market volatility as expressed by the move indicator and alleviate what volatility does to currency supply conditions. Basically, volatility in currency supply freaks the shit, causes people to sell everything. All right, thank you for listening to my opening rant. Appreciate it. Holy Anoli, good morning, Captain Tapsy. Hey, y'all, Diego. I'm happy that I have waited for tap exposure. As always, TGE are always overpriced. What do you think? Uh, no, what did they launch at? Like maybe it was $2 and then a buck 30, but the price action went live at about a buck 30. That's all good. I don't have discount. That's all that matters. And that's basically buy at the cheapest price possible, which implies buy the bottom, which is nobody knows when bottom is. Um, but you don't have to buy the bottom. And then once you own, you're just along for the ride. Own. There's a difference between owning and trading is means you have confluence from a technical standpoint, and you're taking advantage of volatility. This is certainly a discount relative to recent price action. I mean, that was up quite some numbers. It's down what 50, 60% from its high. Take a look real quick. Yeah, it was at four and change more, 70%. Okay, volatility. Finally getting an uptick in the daily RSI and Stoke as well for that matter. That thing just kept going down, down, and down. Brand new asset. You don't have weekly anything. So from a daily perspective, you get a full reset. Bubble, and now you have people that are stepping in. This is a desirable price point. I mean, there's no new issuance. It's not like supply is increasing, so it's literally dependent on early round investors that got significantly cheaper than this price. But the selection of early round investors is quite different than other protocols. So we can speculatively or optimistically say probably a decent price. Um, Certainly a discount relative to its local high. It's not a discount relative to its launch price. And we don't know what kind of revenue it generates because it has not launched yet. So that creates a complexity with regard to an investment standpoint. Same rules as always apply. You buy cash flow positive assets at a discounted price, of which a variety of those components of that equation are missing for this particular instrument. From a personal sentiment standpoint, I'm quite fond of the protocol or what it's supposed to be. And given due diligence, actors involved, and the amount of time it's taken to actually deploy it, I feel quite comfortable with what they're going to deploy. Quite unique in the landscape of crypto protocols and the failures that we've seen over the last years. The amount of energy, effort, and money they've spent in deploying it implies it has a higher likelihood of succeeding and working as designed as compared to endless other protocols. Anywho, we'll see. Looks like markets have stabilized a bit. I Quite comforting. We're already up at 56K, down to 52 and change for a little bit. So last week down 52.5, which is a great price point. Look, if the 50 SMA is what holds, last week's price point of 52 is literally the discount. And now we get to see the bubble, how far diverged from a moving average we get. And the longer the moving average, the more significant a potential bubble. And look, we're significantly above the 100 and the 200 SMA on the weekly. So from those moving average standpoints, this is a bubble price. It's at a premium. It's not at a discount. Discount and premium are always relative. You go out to the monthly, oh dear, Bitcoin could literally crash to the 100 SMA in the monthly, and it looks great. Higher low, there was a higher high. That's just a mean regression with insane volatility. But that would literally be a relatively decent chart structure. Look, I mean, come on. That'd be just like harmonic. And that'd be insane if this is like the 100 SMA. I mean, that would look at that thing. That would be insane. But what? That's just an absolutely insane volatility expression from peak to trough with higher lows and higher highs. Oh dear. Okay, this would absolutely drive people mad. This would drive people mad. But that's the monthly expression. Let me delete all this stuff before it actually drives people mad. Can I delete it? It doesn't want me to delete it. Delete. Delete. One more. I want to clean up my chart. Boop. That would drive people mad. And I am not in logarithmic, so logarithmic would have looked a little bit different if I drew it. Anyhow, hope that helps, Diego. Frank, good morning, Cap. Grateful for the income from our core assets, pays the groceries and utilities. Humility is the lesson. Wake up one day. Yeah, so there's like hindsight that I mentioned in like the stream's title. I have learned what I need to know to do differently. Would I have done things differently? Yeah, it would have been nice to take all time high and throw it into 5% or an FXB or literally a urine pool. That would have been crazy, but whatever. You're not, you don't dwell on the past, you learn from the past. So that's the greatest contributing factor into my methodology going forward. There's no buying on the way up. I'm not a trader. I don't even want to take advantage of an opportunistic trade. It's just not what I want. Even though me being able to inspect from a technical standpoint, I could probably scalp some big returns, get a massive ascending triangle that has a measured move of 100%. Raging bull market. All right, literally double your portfolio in a week, 2 weeks. That's great. That's okay. I'm not doing it. Why? For many reasons, but first and foremost, work. I don't want to do work. The whole point of all of this that we do is to not do work. So I have more strength and comfortability in saying everything I do going forward is rigorous procedure. More comfort than I've ever had, more preparation than I've ever had, based on past experience that was good. Capital loss isn't bad unless you lose everything, in which case real mistakes were made. But even through not my naivety, but my ascension of critical capacity, understanding capital management, I still had roots as an investor. Still had, and that's why I did what I did in 22. So in hindsight, I made the correct choices to invest and own. I just didn't optimally execute on effective discounts. You can't get the cheapest price possible. That's it. That's the failure in my hindsight perspective. And now going forward, when do you buy? You don't buy on the way up, and you certainly don't lock assets on the way up. So, interestingly enough, what does that reduce the bull market to? The bull market is for capitalization. The bull market, your principal's appreciating, your portfolio's appreciating, which basically means it's maturing and it's going to express what the market thinks of it. Capital will flow in and we'll see whatever price point it produces. The business activity will churn, producing the revenue it produces. And, clearly, as many people are thinking, it's like it's a bull market. So when you make an income, just denominate it in Bitcoin, denominate it in Ethereum. All right, fine. I'm probably not even going to do that. I'm kind of considering very much, and this is likely, overwhelmingly likely, the case that's just cash on the way up. Everyone knows, the great macro economists know, with the yield curve on inversion, that recession is coming. How do they pull off a soft landing with the structure of the system as fucked up as it is? So, just aside from trying to time things, accumulate Bitcoin, accumulate Ethereum, fine. You get an extra 100% on cash flow. All right, it's okay. I don't want to time things. The businesses will appreciate. The cash flow will significantly increase. Stack cash, stack cash, stack cash, and the operating procedure is buy things when they're dirt cheap. And this is very much Buffett mentality. Why do you think he has a pile of cash? He'll wait. And unfortunately, he doesn't have too much time to wait. But clearly that's what the pile of cash is for. He'll wait for a recession, which we haven't had since '08. like a significant uncontrolled downturn, which is an uncontrolled collapse of currency supply resulting from likely forced liquidation in sectors of the market that regulators don't necessarily have complete control over. That's what he wants to buy. And I like that. Stack cash on the way up. When everything collapses, buy as cheap as possible, rinse, repeat. Over the next 20 years, you'll look back and you'll say, I made a couple of moves every couple of years and I accumulated a lot of assets. And that's literally Buffett. And the only reason he has such a portfolio is because there's so much damn income from the businesses that he owns. He has to figure out what to do with the capital. And otherwise, this type of methodology is relatively slow and very much a long time horizon type of methodology. Anywho, um, hope that helps, Frank. I appreciate actually paying for things. That's quite meaningful because that's additional income, that's additional salary that you worked for in the past and you invested, and it's benefiting you in the future. So investments. Little digression. There's this guy that I was watching the other day, Caleb Hammer. I mean, if you want to get a sense, this is got 1.4 million subscribers, so he's quite popular. He's Why is he quite popular? Because he's belligerent, he's cold hard truth, critical, angry, and frustrated, and it's general public financial audits about how horrible financial management is in the general public. This is the point of me sharing this isn't to be uh, excessively critical or scorn or mock the general public. It's that how many folks really understand or really hear the words from the general public and how they see credit and how they see financial management. So this is a way to see people. I'm pretty sure this isn't scripted. I believe this is just an expression of the absolute fiduciary failure of the general public in having not even a bad capacity to manage financials. It's literally the stories that I've heard are cringe of just not only bad decisions but the worst possible decisions. I've never seen any, but that's the whole point and why I'm sharing it. If you've never seen or heard what the general public thinks about credit and managing finances, how could you know the relative perspective? So it's important to have all this information as context. Um, I don't know if it's entertaining. I guess that's something I do ask myself. I don't think it's entertaining. I see it as something that's educational, for what it's worth. Anyhow, 1.4 million subscribers. And meanwhile, my content. I appreciate all of you, obviously, 169 people, but be tiny little people trying to do something a little bit better. Pretty crazy to think about that. But look how many people are into that content. There's hundreds of millions of people in this country, and millions of people watch him because they're trying to see how bad people are with capital management. And it's about 170 people here that are proactively trying to do things in a rational way, strategic way, long time horizon investor way. Sir Joe, Joe Reynolds, Raul, Dates. Hey, now we're looking clean. Have you seen these tapioca prices? Yeah, I showed it briefly ago. No need to rehash it, but yes, indeed. Arrow, good afternoon. How are you? Uh, are they coming to Linnea? Okay, so that was the whole. It's one of the more popular chains, and obviously akin to what we saw in like 2020. Because got to remember this. This is only one cycle. there was nothing other than Ethereum mainnet in 2019. You really like really understand that, folks? Uniswap V1 had a half a million bucks, and that was crazy. And now we just have this landscape. So of this landscape, the more interesting ones, EVM, Linnaeus from consensus, the Ethereum consensus. That's crazy. So, just didn't buy it cheap enough. Hindsight's a bitch, is what it is. So, listen, you look back in 4, 8, 12 years, and your Linnea exposure vis-a-vis Nile is worth 100 times the value it is currently. Does it matter you bought it at a wrong price? I don't. I would argue no. My man, heck of a ride we've been on. We'll be able to tell stories in a couple of years. Lake Meadows, peace. Noah, can you help with some navigation? What is your rectember and October according to technicals land macro indicators? Um, you see, you really got to go from a dollar perspective. Looking at the Bitcoin charts is going to drive you freaking nuts. So they cut very much dependent on how forward looking global investors were in managing their leverage in their global carry trades. It's not just the yen carry trade. The dollar is a carry trade. Everything's a carry trade. Credit cards are a carry trade. Credit itself is a carry trade. And that's what the content from this dude basically means. Credit's a carry trade and you're borrowing at 20% because that's what people are apparently. And you're not making 25, 30% on what you bought. Fucked up carry trade. So if you buy a car at 20%, that's literally a depreciating asset that's producing no revenue. And oh my God, it's literally the worst carry trade in the world. Unless you borrow that capital and you're paying the interest and it's free. It's like you do a home improvement for 100 grand, and the 100 grand you're able to make 15, 20%, which is like 20 grand a year, and you took the 100 grand and you're paying like 10% on it. All right, it's a no-brainer to take the 100 grand at 10%, and your invested 100 grand is making 10, 15, 20 grand a year. So you didn't have to unload uh, your accrued capital, be able to borrow it, and the accrued capital is working for you, which is completely compensating for the loan's interest rate and making a premium on top of it. That's by definition a carry trade. But if the investment's not making a return, it's literally, and that's the general public. They fail at the carry trade. They fail at the concept of credit, understanding how to use it at least properly. You have to unwind the carry trade if it's failed. I mean, literally, I was watching one of those shows by him, and the calculated time it took to pay back the interest was 61 years. Someone had debt. I think it was like 150 grand, give or take. 61 years. And this is what the general public has done to themselves. And that's I don't even have words. Anyhow, my man. Arrow, Nile up 20% on 24 hours. Thanks, Ave. All right. Yeah, I would like some up. I would like some additional revenue. We've been through austerity, my man. These are the down numbers. And I would like it to stop. Okay? Do you hear me, the dollar? You hear me? Treasury? Make it stop. Thank you. Gaming Larry, yo Cap, what do you think happens to the BTC price in the coming, it's let's say 6, 12 months down the line? That's not up to the Bitcoin price, that's up to the dollar, and that's up to collateral market. The dollar falls through these critical long-term supports. It's going to get weird because this is not a 2020 market with nascent crypto EVM chains. There's a robust financial system, the $170 billion in dollars. This isn't your 2020 market. So it has the potential to appreciate, or be rather said, be appreciated to a completely different degree than it was in 2020 and 21. This is the early stage of an investable landscape. Rates of return, adjusted, risk adjusted return, and lendiness with protocols that have survived an absolutely punishing deflationary impulse. I'm in the camp of everything up until the uninversion of the yield curve blows up some large actors and you get a cascade of liquidations, and you blow the VIX and you blow the move through the roof yet again. Then everything collapses. But that's exactly why I am further reinforced to not be interested in price action, and revenue is just savings, just accumulate. If you have enough revenue and you get a big deflationary impulse, all right, throw it on Yearn and a USDC pool, and you get them 5% on the money. Mill is 50 grand. All right, great. But then maybe you're like, all right, let's play around. Let's do some LPs on Curve, a little Llama, something on Fractal, and maybe get 10%, 15% FXBs, an FXB and a USDC, or a Frax FXB, and get some outsized returns. You have enough money, you could take significantly less risk. That's really the whole goal. Now, it may take a couple of cycles to get there, but that is a good goal. You want to be able to take less risk and make a decent amount of money, and that affords you the luxury of time to make choices and decisions. Hope that helps. Dantes, when it comes to AI models, have you tried using something like Claude 3.5 or Perplexity? Perplexity is super optimized for latest internet browsing. Yeah, I don't use ChatGPT for browsing. I think I agree with you with regard to Perplexity and Claude. Um, I don't use them. I think ChatGPT is just fine for me and my coding. Um, I, I I don't need it much for coding. I could code anything on the Android platform, but I could appreciate the whole effort that's going on with AI to allow novices to do relatively sophisticated coding. But I just have a decade plus, 14 years experience in Android. It's not going to know the architecture. It's not going to know how I know how to code things. So I don't need it. It's not useful to me. So I guess the question really is, what do I use it for? I use it basically for rational legal document drafting and construction. So even at that, I need to write a lot of language because it's just not perfect. And I need my shit to be perfect. So, but it's useful because at least it's rational. And I find it incredible that useful to have a sounding board, something to bounce ideas off of. And it allows me to enhance my productivity. You can't depend on it to be productive, but you can depend on it to enhance your productivity. That's AI status right now. With regard to internet searching, Perplexity sounds great. Um, it's a lot. It's a lot. It's endless AI tech. I was looking at AI. What was it? This the reflective playground. Oh, it's already offline. It's that 70B that came out. There's Glaive, and there's the repository, Gemac. Nope, that's free pick. Grok is another one. It's just endless. This is really fast, by the way. What was this? This was the new playground for the 70B. I mean, its reflective capacity is astounding. Like, this would be fascinating to have, ChatGPTs and Claude's like memory wrapped into it, because that memory is insane. Memory on ChatGPT is insane. Like, being able to really build out rules is quite useful. So those are very constructive components of these utilities. If that helps with topics. Assoon's in the house. How are you, my friend? John Steps, I got a few in my van. If you're at Cindy's Snacks today, my man, I don't know where you're going with that. Arrow, is it a red flag that you have tap token is out, but there's no actual product launch yet? Um, I don't know. I don't know. What happens? Look at the investor base. Vested interest is critical to understanding a lot about a token, how much and the vested interest we know is well aligned. It's not down only. There's no emission. So literally all the sell pressure. It's not much. There's a analytics. We have it. That's the happening. Is it this? Oh, it's down. They were doing analytics that talked about how what percent of the seed investors are exiting, and it's the vast majority have. Um, so it's not necessarily a red flag. Uh, but we know many things. Greatest in technology is not necessarily the greatest investment. And what's a discount? We don't know the interest rate, so we can't calculate X, Y, Z. How much does it cost? How much is it paying? And how likely is it to continue to pay? So this is firmly in the spec revenue category, which means greater risk, greater return. Completely unknown. Unknown until it goes live. But it screams everything I want to hear uh, with regard to functionality. All right. This is where sizing of positions makes all the difference. Win big, lose small, stuff like that. Position size means everything to survive. Foam form. Can you think of any reason or any player who would be in pain during yield curve on inversion? Oh yeah, interest rate. Means interest rates are going to change, and that disrupts the entire flow of capital around the world. That means you know a likely outperformance of emerging markets, and that's an outflow of capital from the United States overseas into emerging markets, and capital flows from underperformance to outperformance. So if capital is flowing out of the US into emerging markets, US is underperforming, which will further encourage capital flow to transfer or to change directions from underperformance to outperformance. The flows are self-perpetuating and they grow very quickly. So yield curve inversion will changes the entire structure of the system. It really invalidates what is a viable investment. It will be very painful. But find great comfort in understanding that crypto is not a US market. It's fintech, accessible to all markets of no market, permissionless credit, the biggest business in the world dealing with liabilities, which is currency, foreign exchange, credit, derivatives. Crypto isn't crypto. That's some stupid terminology. Crypto is fintech. Crypto is business. These are businesses. And it's a disservice to call it crypto. I mean, it's a bank. It's all a bank. These are all banking products, period. Don't need anyone to define it. This is what it is. I don't need a country's regulatory authority to tell me what it is, or some famous macroeconomist or politician to tell me what it is. This is what it is, unambiguously. Hope that helps. Um, I find it a little bit of a red flag that the top team keeps making. Okay, they are certainly uh, not hyperbolic, but excited and arguably prematurely excited in the tone and expression. I I like it mostly. It's good vibes. I believe they chose good investors. I believe the tap price is incredible considering it hasn't launched and it's held up extremely well. Now, what does that mean? Held up extremely well. Yeah, this is held up extremely well. If you don't remember 20 and 21, you launch and the price goes like this. It's not doing that necessarily yet. So, okay. uh, Maybe you won't, you can only measure from hindsight. Maybe it's a red flag, maybe it's not. Maybe it turns out to be the greatest protocol since JP Morgan Chase. Who knows? The whole question is exposure or not, and at what price, and at what size, at what price. And you want the cheapest price possible, and you want a size that's respectful of the portfolio, the overall composition, and you know relative the proportionality of the portfolio. Size spec bets properly. That's it. So, yes, a good statement, John. And then put it up on the screen. Testnet, can't deliver. Yeah, true statement. Good business is under promising, over delivering. Very true statement. Very true. My plan is to capitalize on tokens like GLP and JLP. Well, those will just be printers during a bull market, of course. Anon, will other protocols adopt Paladin Warlord coins? Unknown. Uh, my general sentiment is for 12 years from now, you'll see a Warden and a vote market list that has 1,000, 5,000 different rentals on it. That's just makes sense to me, and that's the expression that I see most interesting because clearly that's the cash flow. But that's also a product. It's a fintech product. The financing of liquidity and the capacity to rent that financing at a rate that is discounted relative to self financing of that liquidity. That's a fintech product, a B2B product. I don't know about the Warlord coins. I think I like Paladin's products. I like Stake DAO's products. I like a lot of products. I certainly am no hater. I am an appreciator. Hope that helps. CDX Aura VELP. Aura balances the part of the equation. Plenty of exposure to Aura and balance it for what it's worth. I sure as hell just my statement that I make at this point in the market is I sure as hell hope they do what everything else does. They are appreciated because man, these guys have been working for years. It's meaningful tech. I think it's quite. I remember when Balancer launched. That's it's impressive tech. But best tech isn't always the best investment. Killis, good morning. How are you? Foam form, following up on inversion questions. So the pain would come from DXY depreciating in value due to lower short-term interest rates, causing foreign investors to leave U.S. equity markets. Well, better said, you'd see it expressed in the DXY. The DXY comes down, which this charting structure indicates to me, as well as gut instinct and sentiment, is that we get about a decade of dollar depreciation. That would be literally uniform with past experience. So past experience doesn't repeat, but it often rhymes. So we didn't get a similar high, but we didn't get a high back then. So maybe we get a double bottom, and your bottom 71. You certainly didn't have a double bottom here in 2005. And maybe that's where it ends. So it doesn't necessarily have to uh, repeat, but it could rhyme. So we next in the cards is likely a dollar depreciative cycle, and that's over the next decade. So that is something that is a very high time frame type of inspection. So as dollar depreciates, foreign currencies are appreciating. Increased purchasing power in foreign currencies. There's much more foreign currency on the planet than there is dollars. Therefore, significantly increased purchasing power. Therefore, significant capacity for the world to inflate asset prices. Food for thought. And that also shifts the supply and demand balance to US domestic manufacturing to export goods using a relatively cheap and depreciating dollar, selling it for a more expensive and increasing in price, appreciating foreign currency units. So this is also consistent with the deglobalization type conversation. Repatriation of supply chain type conversation is a cycle of dollar weakening. So that's generally my sentiment for what plays out over the next 4, 8, 12 years, a dollar depreciative cycle. Most people don't understand or don't know that the dollar has been in a raging bull market since 2008, producing one of the largest blow off tops since 1985. Let me see it better on the 6 month. Look at this. That is an absolutely monumental blow off top in the dollar. That's a shooting star candle. Candles matter. Follow up month is a bit of a spinning top candle. Then you have an inverted hammer, and and you can't make this shit up because this is on the verge of being a bearish engulfing. Note that this is a 6 month chart, so we got 6 months to close below bump 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 101.3. You got a 101.3 or lower in price. Dare we break the 10 SMA on the 6 month down at 99.5? You got an insane series of candles for 2 years of DXY candles indicating bearish continuation. These are 6 month candles. That's some high time frame preference, ladies and gentlemen of the crypto space. I appreciate the 180 people, human beings around the world that have made it to the end of the stream in the effort to be a little bit more rational today. Hope you have a wonderful day. It's Monday, September 9th. So we got a couple more times this week. We will see each other. Y'all have a wonderful day. Catch you then. Peace.